the fact that I always love to share with people who ask me that is that the market has averaged 10%, which I'm going to show you right here, right now, but it's never done that in a calendar year. So people tend to anchor to a percentage. So your listeners might think, okay, 10%, but last year it did a negative 22%, and this year it's up 11 to 12, 8 to 12, depending on the index or the segment of the market you're looking at.
I had the chance to sit down with Dallin Cutler, a vice president and partner at EP Wealth Advisors. He is also a certified financial planner, and we had a conversation around how the stock market really works. More specifically, where people tend to do well and where people tend to go wrong as they approach investing in the stock market. I hope you enjoy. I have all kinds of questions about the stock market.
Please.
There is the stock market, and there are shows on TV about it. There are movies made about the stock market. There's all of this information out there around the stock market. But what is the stock market? Like, break it down for somebody who's a beginner.
Yeah. I would say that the stock market is simply any publicly traded company. So you can think of any company that you want, private or public, small or large. And all the stock market is the biggest companies that have gone public. Public meaning that anyone can go and buy ownership in those companies. So like my firm right now, we're a private company. If you came and said, hey, I want ownership in your company, it's not going to happen, And so,
Unless I brought enough money.
Unless you brought enough money and you did all this for us,
Right.
then I would vouch for you. Where a public company, you can. So if we were to ever go public, or any company that's private goes public, then anyone can go and buy ownership in that company and participate in the ups and downs and growth of that company over time. So that's usually how I explain it. Is sometimes people think, they just say the stock market as just one big entity almost.
Yeah.
Like it's just you're investing in the stock market. When really, when you dress it down, you're just investing in really large, really successful companies. That doesn't mean they're all going to be successful, but a lot of them have been to get to that point to go public. And so that's what you're investing in.
Yeah.
So hopefully that answers.
Totally, that answers it. So when like stock market, I'm going to just go to the Wolf of Wall Street for whatever reason.
Yeah.
So Wall Street is the idea of like, oh, that's where the stock market is. But can you kind of break down that there are different stock markets, if that makes sense?
Yeah. So I think what you're referring to is just different exchanges or places that you can buy these companies.
Yeah.
And so the two most famous or well-known are the New York Stock Exchange and the NASDAQ. And so both in New York. So you're right about that.
Yes.
And so a lot of those companies that are public, when they go public, they're traded on this exchange. So when you're going to buy ownership in one of these companies, you're buying it on this exchange. Now, most people are removed from that because they're going to Robinhood or to Schwab or Fidelity and buying it through there. So it's not like they're going to the New York Stock Exchange website to buy those stock positions or ownership in those companies. So, and those aren't the only ones. There's other publicly traded markets. There are a lot of international companies that are listed on the New York Stock Exchange and on NASDAQ. But there's other international stock exchanges too that exist where you can buy other international companies, which I'm sure we'll get into as far as why you should or should not buy companies like that and the benefit of diversification if you do. So
to go on that a little bit, are you saying that there are also companies that are not on the New York Stock Exchange and NASDAQ that are international companies in these other positions or in these other areas?
Yeah. So when you say like other countries, is that what you mean?
Yeah.
So
like doesn't Japan have a market?
Yeah. So there's a few other exchanges, international exchanges that I know other countries have created for companies that they want to list or go public to the people that live there, that we can also go and buy access to, because there's a lot of people outside of the United States that buy companies that are inside the United States on our exchanges. So, which it's good to be aware of. Again, I don't spend a lot of time talking about that with clients because we're not doing that, meaning it's the funds or So when a mutual fund, which I'm sure we'll get to too,
Yes.
I'm getting ahead of myself, but it's just a basket of stocks when you
Yeah.
buy a fund. And so that fund is going and buying these different individual positions or stocks on all of these different exchanges. And so they make technology's made things so easy for everyone that we don't have to think about a lot of that stuff. But when you do dive down into the weeds, that is what's going on behind the scenes as far as all these publicly traded companies on all these different exchanges.
That makes sense. So
hopefully so.
So we've got businesses that want to go public and they want to sell a piece of their equity in their company to people, and the public can now buy it. Why buy stocks from an individual's perspective now? Like, why invest in the stock market as opposed to real estate or yachts or whatever else that people can invest, gold, silver? Like, why the stock market?
Yeah, it's a great question. I talk about this a lot. And obviously at our firm, because most of all the clients' assets that we're managing are in these public markets and a few private investments, which I'm not here to talk about that. But people automatically think that I'm just biased towards stocks and investing in the stock market, when that's not the case. We have a number of clients that invest and own real estate and are really successful. And so there's just pros and cons to these different asset classes. The biggest pros that I think exist in the stock market is the liquidity, which is the biggest one, where you get to, I always think of private equity or a private company. So like imagine you had a friend that came to you and said, hey, you should invest in this private company. Look at the returns. Look at what they've been doing all this, like for the last 5-10 years. You should invest in this company with me. There's early access. You can get in and participate in the uptick. And most people are like, oh, I can't pass up this opportunity. And it's an awesome opportunity to invest in this company that's massive that everyone knows about, where the stock market's doing that for you because it's public. So you can go and invest in Apple or Microsoft or Tesla, and you can literally invest and get ownership in that company today and sell it 5 days from now if you wanted to. So that liquidity that it provides, especially for people that are moving into retirement, what we tend to see is people want flexibility. So I'll use real estate as an example.
Yeah.
Real estate's less liquid, meaning the principle of your investments. You get cash flow. So if you're renting a property, residential or commercial, you're getting cash flow from it. But if you wanted access to the full investment, the value of the property itself, you'd have to sell it.
Yeah.
Where most people who, even clients that have accumulated their real estate over time, like that's what they did.
Yeah.
They get to retirement and they start to phase out because they don't want to deal with property managers, or they don't want to manage those assets themselves. They want flexibility. They've been comparing the returns between the two, and they've been close. I think real estate's going to get a higher return, but you're also losing liquidity by investing in it. Whereas the stock market, again, is liquid. You can get access to it. And so a lot of people want that. And so if they say, hey, we want to take all our kids and grandkids on a cruise, and instead of living off just the cash flow that we're getting from the properties, they can still be generating that cash flow, but they can go and say, hey, we're going to pull $20,000 or $30,000 out because we can, and go and invest, or go and pay money and go on a cruise, or take our kids or grandkids. So I think that would be one of the biggest reasons. There's others. I mean, there's real estate can be, there's a lot of tax advantages when you invest in real estate. The most common one being the depreciation of the property. Yeah. So you invest in a home, you can depreciate that home, which offsets any cash that's coming from it. And so, which is big. People love it.
Yeah.
Sometimes what people don't think about is if you're depreciating the property, the basis in that investment goes down as you depreciate it. So if 20, 30 years down the road, you're tired of it and you want to get rid of it, you're going to recapitalize, you're going to pay all those taxes again after depreciating the property over a period of time. Now, you get a step up in basis if you die, which is another component to keep in mind. But with stocks, you can do certain things like that too. You can, a common practice when you're investing in stocks is you can tax loss harvest. So if you have a stock, like let's say you own Coca-Cola,
Yeah.
and Coca-Cola drops in value. It goes from $100 to $50. You can sell Coca-Cola and realize that $50 loss.
Mm-hmm.
And then you're not allowed to buy that same position, but you can turn around and buy Pepsi. So same industry, very similar stock. You can turn around and buy that if the market goes back up and you're just harvesting losses. So you're not selling to get out of positions. You're just harvesting losses along the way, which would offset future gains in the future. And so that's kind of a tangent, but
Yeah, that was a fun tangent.
I kind of went off on a tangent, but I think the biggest, to come back to your question, is simply the liquidity that public markets provide. I mean, I just think it's so cool that anyone can go and invest and participate in the growth and wealth and prosperity of a lot of these successful companies, and they can get in and out so easily. Now, there's downsides to that, which we're going to get to.
Yeah.
But there's a lot of positive to it too.
Yeah. And I just want to clarify liquidity too, is just the amount of time between when you want to withdraw cash and have it be usable. Is that
Correct.
my understanding of liquidity
Yep,
correct?
exactly.
Like a house, I have to list it,
Right.
sell it, close on it, all of that stuff before I have that money to use.
Right.
Stock market, it's quicker than that.
Yeah.
Yeah.
2 to 3 business days.
Yeah.
That's what I tell people.
That's awesome.
Yeah.
As we go through the stock market, we talk about kind of some inherent risks and stuff, but it seems like the stock market has the potential to be volatile. Now, we've lived through kind of that 07, 08, 09 periods. We've lived through COVID was all over the place, both negative and positive. Why is the stock market volatile? Why does it move so much?
Because it's publicly traded. So, and that is the reason. So you have to, because you can buy and sell at any point, you have to know what the price is of that company at any point during the day. So again, compare it to real estate. If I were to say, hey, Erik, you need to sell your house today, and it was a thunderstorm, like it was raining, there was lightning, and I'm like, but you have to sell it today. You'd be like, well, man, I'm going to have to discount what I'm going to sell this house for to get someone to come through this storm to come and buy my home today. I think of that analogy when I think of stocks moving on a daily basis. So there's a ton of different factors that are causing that price to go up and down. A lot of it's just emotions of people that are buying and moving in and out of that position. So that's why in the short term, there's that volatility, which is why for most people, I mean, clients for sure, but most people, I say, hey, have a game plan when you go and invest in the stock market. If you're less than a year, I usually tell people I wouldn't if you're going to need that money over a short period of time, because we don't know what it's going to do.
Yeah.
We don't know what the news cycle is going to be like. We don't know what the Fed's going to do. We don't know this or that. And so, but if it's longer than that, then you can, I mean, if you just look historically, you can start to really earmark and say, okay, if I have a runway of 2 to 5 to 10 to 15 to 20 years, very high likelihood that I'm going to have a positive rate of return and participate in that growth. So there's a lot of noise short term. Long term, the power and ability and the success of these companies tends to get vetted out.
How do you help your clients and even yourself personally, in a way, ignore that noise? Because I feel like the emotion is such a big component of it. And when I first downloaded Robinhood like years ago, it almost like gamified everything. And so I'm sitting there like every day, like watching and checking, and and news is coming in. How do you advise people to help with that?
A lot of teaching, and I'll give you a good example. So I did a video that I sent out to all my clients last year, because last year was a down year in the market. So that's when I'm having a lot of these conversations. And in Q3, so at the beginning of quarter 3 of last year, 2022, so clients always get their quarterly statements at the end of the quarter. And the market literally bottomed out at the last day of Q3. So it went from, it was already down, but it saw a big decline in Q3 when all of our clients got their statements. And so they're just thinking, what in the world happened from the last time I looked, which was probably the previous quarter, which prompted this video where in my video essentially said, don't look at your quarterly statements. And I joke about it because I'm not saying I don't want you to look so you don't ask me questions, but we're never investing someone's money a quarter at a time, meaning we're not trying to maximize those returns a quarter at a time or even a year at a time. We're looking, the adjustments we're making to an investment portfolio, we're looking 3, 5, 10, 15 years down the road and saying, hey, which positions or which companies do we think are going to continue to outperform over time? And so if you're trying to maximize your returns on a daily or monthly or quarterly basis or paying attention to the movement, you're going to drive yourself crazy. And some people, candidly, I think they just emotionally, we look for alternative investments if they have a hard time with the emotions and the up and down, because we set the expectations that it will happen. We'll continue to have bear markets. Your portfolio is going to drop 5% or 10% or 15%, depending on how it's allocated. We go through worst case scenarios like 2006, 2007, 2008. And make sure we set those expectations. So I think a lot of it's simply expectations and education. That knowledge turns into discipline. The discipline coming when the market does, you see your investment portfolio come down, you know that it has happened 40 other times previously and it has come back since.
Yeah.
Now, if you're a first-time investor and you put a substantial amount of money in and you see it go down 10%, I would do the same thing. I would be like, oh, I'm out. I'm not like it's like a game. Like that's what Robin had kind of felt like you're in Vegas.
Yeah.
But as you begin to understand how it works, then I think you become more disciplined in your approach to the market and you have a plan in place to help manage those ups and downs.
Let's talk about those expectations a little bit. And there's two sides that are coming to mind here. One is kind of that stigma that you as an investment advisor kind of need to battle of like, okay, a good investment advisor never loses. Like they will never see and I think that perception is wrong. And then at the same time to the individual too, the expectation of like, oh, I will never see these losses. So how you've brought it up that they happen, what can somebody expect in the stock market, or at least historically, how has it performed over the last, you can choose your timeline.
Yeah. I got some data for you.
All right.
I came prepared.
We love numbers.
The fact that I always love to share with people who ask me that is that the market has averaged 10%, which I'm going to show you right here, right now, but it's never done that in a calendar year. So people tend to anchor to a percentage. So your listeners might think, okay, 10%, but last year it did a negative 22%, and this year it's up 11 to 12, 8 to 12, depending on the index or the segment of the market you're looking at. And so it varies from year to year, but the averages, I mean, if you look at it, so just to give some data, so the CRISP 1 through 10 index. So an index, do you want me to explain just briefly what an index is?
I would love for you to explain.
So all an index is it's not something you can invest in. It's these companies that compile stocks that they have certain characteristics. So the easiest one to explain is the S&P 500 index, which is what most people have heard of. They're familiar with that because it's a common benchmark. When people are talking about the stock market, they're talking about the S&P 500. And all that is the 500 largest companies in the United States.
Largest meaning their value stocks, number of stocks times cost per share.
Yes.
Okay.
Their market capitalization.
Okay.
So that's the largest 500. So every year that changes because some move down, some move out, some move in. So any index, when I'm referencing an index, I always explain this is not something you invest in, but it's giving you a really good indication of what all of the 500 largest companies have done historically.
Yeah.
So, for example, the S&P 500 index since 1926 has done 10.1%, has been the average annual return. The CRISP 1 through 10 index. Now, this is an index that is also encompassing other companies outside of just the 500 largest. So small cap or mid cap companies, still publicly traded companies, but their market cap is smaller. Okay,
Gotcha.
so that's the characteristic difference. Same companies.
Lower on the number. If it was the S&P 500, they'd be lower.
They'd be lower. If there was a list from highest to lowest, they'd be on the lower end, middle and lower end. They call them small, mid cap. There's actually other categories too, but for just generally speaking, there's large, mid, and small cap companies. So this index encompasses those 9.9% since 1926.
CRISP is small and mid.
Small, mid, and large.
Okay.
So we're just making the basket broader
Gotcha.
as opposed to just those 500.
Got it.
Okay. Since 1970, so I'm just taking random dates. CRISP 1 through 10, 10.4%. S&P 500, 10.4%. The MSCI World excluding U.S. index, so now I'm looking at international stocks. Okay, so I'm excluding all of the U.S. stocks, and I'm just looking at international publicly traded stocks. Since 1970 has done 8.9%. Okay, so with that said, though, if you look since the 2000s, for example, so usually when someone asks me, I say, well, historically, the market's been around 10 to 12, because you can look at any period of time, and I could show you this is what this ugly, big textbook is that I have. So I could earmark a ton of different windows of time and say, oh, this was 11, this was 12, it was 10, it was 9. But it kind of ranges 9 to 12%. But if you go look since the 2000s, the market's been around 6 to 8%. We've had like the deviation or the mean has adjusted down for stocks and bonds. Do I think that will continue? I don't know. I'm not that smart. But that's how I would set the expectation for someone, is this is what it's done historically, because no one knows what the future holds.
Yeah. So you're saying, like, so if you say the average, again, you said 10.1% for the S&P over since the 26, no, like individual year is actually like 10%.
No.
That's just taking.
There's one. Don't hold me to this, but I think there was 1 year, and I can't remember if it was the S&P 500 or the CRISP 1 through 10. I can't remember what index that was 10.1. So I know there's been years, but I know for sure that there's never been a year where it's exactly at 10%.
10.0.
Which I think is good to my original point, that people anchor to that.
Yeah.
And so what they're expecting on their statement every quarter is 10%. Where's my 10%, or at the end of every year. And that's just not going to be the case. The only way you're going to achieve those kind of returns, if the markets continue to produce that, is if you stay the course and are unemotional and can handle the storms that will come in the short term.
So this is kind of related, I think, but I've had a lot of friends or family members of friends that have written these complex algorithms that can recognize the velocity that something is increasing in price and then buy at that time. And then it'll recognize when it starts to dip down and sell at that time. And it's not just with stocks, but it's been with like currencies and Bitcoin and everything else. How easy is it to time the stock market?
I think it's really difficult. I actually have a quote that just sums it right up. So there was a guy, so there's a book called The Man Who Solved the Market. I don't know if you've ever heard of it.
Yeah.
So it's about Jim Simons.
Yeah.
And Renaissance Technologies. So they were a company that essentially did solve the market. So they got a bunch of mathematicians together and put together these algorithms and said, okay, we're going to place... I'm not smart enough to even begin to explain the algorithms and what they did and how they would trigger when to buy and when to sell any of these publicly traded instruments. But the quote from the book that stuck with me that I went and looked up, this was at the very end. It said, so this is Jim Simons. He said, we were right 50.75% of the time, but we were 100% right 50.75% of the time. So my takeaway from that was he spent, and by the way, they didn't figure out this algorithm like right away. There was a lot of trial and error for years to get to the point where they were only right on all of their trades 50.75% of the time. But because they were sure that they would be right, they would leverage it. So they'd make a trade that made a little money a lot more because they'd buy on margin. Or so they'd amplify that return. But I think that's crazy, because if you think of just your neighbor down the street who says, hey, I've got an algorithm, I just think of Jim Simons every time because I hear that too. I'm like, well, if they took years and years to figure out an algorithm that was only right, barely a coin flip,
and not a small amount of money,
then the chances of just an individual fit, and I'm not saying it's not possible.
Yeah.
I also think it's getting more difficult because of information and technology. Markets are becoming more and more efficient, meaning you can go, but news travels really quickly. It's priced into the share price of a company real quickly, and so it's really hard to be right 50.75% of the time without other people recognizing if something's mispriced, which is what those algorithms or anything are trying to do. But on a broader scale, I think stuff that's more applicable, market timing is just really, really difficult. There are a number of examples that show how hard it is to time the market on a consistent basis. I have a chart that I always use, and it breaks up different areas of the market. So large cap companies, small cap companies, mid cap companies. There's growth companies versus value. I don't know if you've heard of that term.
Yeah.
So growth I just think of as tech companies. They have huge upside. They're not all tech companies, but a lot of the growth companies and value companies are kind of the blue chip, more stable companies. And all of these different companies that have these different characteristics perform differently during different periods of time. And so I have a chart that shows which one is outperforming every given year, and it's just a collage of colors. I can send it to you and we can throw it up there, but it's just a bunch of different colors. It's showing the difference where it's really, really hard to predict on a consistent basis. And we have evidence that proves that because I have another one that I just thought of that I brought.
And is the point of that chart to show that in any given year, maybe it is the blue chip companies that are outperforming the higher growth companies, and then the next year it could flip flop or some other entities are coming in there?
Exactly.
So you can't say, blue chips consistently will outperform.
Right. And what people tend to do is think of most people participate in a 401k plan, and most 401k plans default you into a fund that is correlated with your age. So more aggressive, the younger you are, more conservative, the older you are. But a lot of people who choose for themselves, what do you think their analysis is when they go and choose what funds to invest in? They just go and look at the last 1, 3, or 5 year return, say which one's doing the best, and that's what they put their money in. And most of the time, now it could keep going for a period of time. It's not like it's a guarantee that if a fund does really well or a segment of the market does well, it's not going to the following year. There's times when it does for 3 to 5 to 7 years, and there's times where it flips every other year. And so this stat I thought was really interesting. So what this is showing is it's showing the different funds. So I mentioned earlier mutual funds. So which mutual funds are just a basket of stocks. So a basket of these publicly traded companies. And they're graded every year on their performance or how they do. And so what this is showing is in the top quintile. Do you see that there?
Yeah, is it the red one?
The red one.
Gray.
So what that's saying is in the top quintile, or the funds that did the very best, what was the percentage breakdown of how they did the following 5 years? So 5 years goes by. What did the top funds do, or where did they fall 5 years later? Meaning, did they continue to outperform and do a really good job, or did they fall? And so you can see the dispersion that happens. About 20.8% of those in the top stayed at the top, but then you notice how many are in the second, third, fourth, bottom quintile and went away, essentially. So that merged or liquidated means the funds essentially went away because they were bought by a different fund or went away.
And that's the biggest percentage.
And that's the biggest percentage. And so if you start to anchor to these different funds because they're performing in the short term, it shows how hard it is to continue to time the market or outperform over time, because a lot of these funds are managed by managers that are choosing the stocks that are in their fund. So take the S&P 500. I use that example all the time. You could go buy, and I'm getting ahead of myself, but
it's okay. Let's do this.
So The S&P 500, you could go buy an index fund, okay, that buys all 500 of those companies. So all that fund manager is doing is going and seeing which companies moved in, which companies moved out every year, and then they're going and copying that. Really low cost because they're not doing a lot of work. They're just tracking the index. Or you could go buy a fund manager, an active fund manager that says, I'm going to buy 100 of the 500 companies in the S&P 500. So you know if you buy that fund, your exposure is going to be in the S&P, but you also know you're not going to own all 500. You're going to own what that fund manager thinks are the best companies.
Yeah.
And so a lot of these funds in this chart I'm showing you are funds that are doing that. So they're trying to outperform because the only way, if you're an index fund, you're not outperforming the market because you are the market with a little cost. Where an active money manager, they can, if they choose the best funds from that group or that listing of the S&P 500, but a lot of them don't, and they don't stay in those top quartiles. So, and these are really smart people much smarter than me that are trying to time the market.
Yeah.
So that's why there's just so much evidence that shows that it's costlier. So those funds tend to be more expensive.
To me, the consumer, I am paying a higher fee to be a part of that. Is that what you're saying?
Correct. Yeah. Versus the index fund. So the index fund is low cost. The active manager is going to be more expensive, or they're going to charge you more if you invest with them because their goal is to try to. So think of it as more risk, more reward. You're paying a little more and you're expecting a little more upside. But what it shows is that additional cost and the difficulty of timing long term. Yeah. So they could do a really good job over a year or two, but to consistently sustain it over 3, 5, 10, 15 years, which should be the window for most people when they're investing, it's really hard for them to do it.
I have some confessions here. So
Please.
like 7 or 8 years ago when I first got Robinhood, I mean, all it does is break down like 5 years, I think is the max that it goes. And so I was looking, like somebody said, oh, you want high dividend paying stocks. And so I was like, all right, let's go to the dividend stocks. Which ones pay the highest dividends? And it would say like as a percentage. So I'd buy up some that had like super high percentage dividend stocks. And I'd sit on those for a minute. And then it was like, okay, I'd look at their 5-year thing and which ones were at the lowest of their 5-year period. And so I'd buy them when they were low. Yeah. Little did I know, like they were on the trajectory to go down. And so I was like trying to play this game. The point is I was trying to play this game. Yeah. And I wasn't looking at the right stuff. I was just trying to outsmart, or I'm the only one who would know how to do this. And it didn't turn out great. Yeah. But luckily I've moved on from that from that strategy.
Thank goodness. Yes. I'm glad you're evolving.
I have great friends that pull me out of the ruts. How would you recommend somebody respond to that pitch, right? Like I come to you, Dallin, like, hey, I've got this fund or I've got this algorithm, you should invest in it, give me your money. Yeah. It's kind of an awkward conversation for me to have sometimes. Yeah. So how would you handle it? Let's say it that way.
I'd inquire. I'd ask questions. My questions more likely than not. I mean, we as financial advisors, especially to our clients, we get this pitch because fund managers come to us and say, use us. Yeah. Like have your clients use our funds. Here's our track record. And usually, to be candid, we don't care about the returns they show us. We care about their process to continue to outperform or achieve or get exposure to certain markets. And so if an individual comes and says, I've got an algorithm or I've got something, I've got some secret sauce, all I'm doing in the back of my mind, now I do this for a living, is I'm comparing what they're saying to the mountain of evidence I have in my head that I've just read through and gone through, and books I've read, and poring over historical returns and looking at active money managers versus passive money managers. And it's hard for me to get over that mountain of data. Now, a lot of people don't have that, which is why even for my clients, I mean, that's what they start to use me for, because they're higher net worth, generally speaking. Yeah. So they have people reaching out to them and saying, hey, you should invest in this. Here's why. And so they'll come and talk to me and vet it out. And so I get exposure to a lot of these different investments. And most of the time, if they sound too good to be true, I think most of the time they are. Yeah. If they say there's very little risk, that's a red flag in my mind, because it just just logically, it doesn't make sense for me to give anyone money without any risk to get a really outsized or high return. And so I don't know if I'm answering your question, but I think that's what I think through. I would just tread lightly.
Is there a time horizon that you like to look at, right? Because I feel like in some of them I've seen, they feel like, yeah, the last 6 months have been great. And then the 7th month is just tanks.
Yeah.
Or the last year or the last 3 years or 5 years. Is there a time horizon that makes you feel more comfortable?
Yeah, longer. I mean, 3, 5, 10 years.
Yeah.
Short term, like 6 months, for sure, no. For me.
Yeah.
I sound like an old, lame person as I talk. I'm a young guy.
Yeah.
I'm hip. I get it. And so for a lot of people that still want to or try, I actually don't say, hey, don't do this at all. Like, I don't like being the no person every time. Like I was saying earlier, people come to me and say, hey, should I do this? And I don't like being someone that's always like, you know, like your parents to little kids, like, no, you can't do that. No, you can't touch that. No, you can't try that out. And so what's nice about a lot of people I work with, and this is something I would tell to anyone, is you should have some kind of a grasp on how you're trending and what it looks like and the number you're trying to get to. Because if you do, then when some of these opportunities come up that might be a little riskier, even if it's like your best bud and you're like, you know what, I want to support him or her and I want to give them some money and it seems like they're doing a great job, then you give them enough that if you were to lose it, you're still going to be okay.
Yeah.
And I think there is room for that, to do that, and benefit from it. And I think you will benefit from it. I actually get more nervous if something like that goes really well for a client or an individual, because then they'll think that's the norm. And that happens consistently when most of the time it's not the norm and they got really lucky.
Yeah.
And so I think it's just expectations, understanding what you're getting yourself into and knowing that, hey, I've done it personally.
Yeah.
There's been some investments that I've put some money into, small amounts, nothing crazy.
Yeah.
And I did it to learn. So just to see, okay, I hear this, but, you know, personally, I'd like to gain some anecdotal evidence for myself of saying, oh, yeah, I did invest in this startup company that I was promised the world and thought it would 50x over the next period of time. And 6 months later, my money was gone.
Yeah.
And I think it's beneficial to go through things like that because it'll make you more rational and reasonable and less emotional moving into the future because they'll get you.
Well, and I love how you phrase, like, you have to be comfortable losing it. And as long as you're not throwing your entire nest egg on black and just you dumping everything in there to where if it lost stuff, you'd be in a really bad spot. Because I think I'm a similar way of like, here's a little.
And I think it applies to the stock market too.
Yeah.
So Tesla, really good example. Tesla, the last year or two, it went on a crazy run where the returns were outsized and everyone was like, we want Tesla. And are we invested in Tesla? We want more in Tesla. And Tesla's an awesome company. Like, they do amazing things and they're growing like crazy. But there's danger in isolating yourself to one investment or one strategy or one startup company. And so we haven't got to diversification yet, but I can't wait to.
You were so excited.
Because it's important.
Yes. It's so funny when you talked about how you get nervous when it goes well. And my mind went straight to like some basketball teams that I've been on where you'll have a player who like makes an off balance shot in a corner.
Yeah.
And you're like, I know that in their mind, they're going to jack up the next 10 shots that they get because they think they're
That's what I do.
I don't think that's true. You're a very good basketball player, which is not part of this podcast, but for everybody else that needs to know. Let's jump into diversification. Why is diversification important? First off, well, I guess backtrack a little bit. What is it? How do you appropriately address diversification?
I address it as investing in assets that are going to do different things during different times.
Okay.
So the simplest, Dallin's version of diversification is that. But more broadly speaking, you're not concentrating your investments, and I'm using the stock market, but this can apply to really anything. If we're talking cryptocurrencies, there's a variety of different currencies, although most of them are down. But there's a variety of different currencies. If it's real estate, different properties in different locations that are different, a duplex, a residential home, a commercial building, that's all diversification because they'll all be impacted differently during different market cycles. And so then the stock market is no different. I love to use the example. I use this example all the time. It was the lost decade, called the lost decade, and it was from 2000 to 2009. So they call that the lost decade because if you look at the S&P 500, which again is the 500 largest companies, usually most successful, they tend to be more growth-oriented companies. So kind of that tech growth, especially recently, that's what makes up the S&P 500. So what happens is people will look at their investment portfolio and they'll compare it to the S&P 500, which is normal because that's a benchmark of the market. And there's times when the S&P 500 is doing way better than their portfolio, but what they're not taking into account is, well, my investment portfolio is also invested in mid-cap and small-cap stocks. It's invested in bonds. It's invested in international companies. So there's broader diversification. So coming back to the lost decade, if you look at the return, so the S&P 500 index did a negative 0.9%. So that's 10 years. So you invest at the beginning of 2000 and at the end of 2009, so 10 years later, you virtually are flat.
Yeah.
No return. Now, for your audience, that was the very beginning of the Y2K bubble. So the market took a hit right at the beginning and then it climbed out. So we saw positive returns and then right at the end of that decade, we had the 2007, 2008 Great Recession, which then came down again. So so there's some reason why that happened. But if you look at small cap value, for example, so there's an index. It's in this booklet, so you can source this so people know I'm not making up these returns.
Yeah, we'll show it for them.
That I'm using small cap value. So these are small cap stocks that are value oriented. That value growth did 12.3%, positive 12.3% over in that same decade.
Yeah.
Emerging market stocks. So in international markets, there's developed markets and there's emerging markets. Developed are more developed countries. Emerging markets are less developed countries. That's the distinction between these two. And you can invest in both. So there's companies in each of these countries that you can invest in. Emerging markets, so international companies in emerging markets or these smaller economies did 10.1%. Now, I'm not advocating that you should have known and put all your money in small cap value. Or emerging markets. But the point is that people, if they're tracking to the S&P, they tend to shift or tilt towards a certain segment that's doing really well. So they might become overly exposed to the S&P 500 or those 500 largest companies. But then all of a sudden, a lost decade happens. We have a major recession. And that's when diversification comes into play in my mind, because you have to do average things when the world around you is falling apart. Your favorite quote that you just read.
Yes.
And if you want to repeat that, because it's an awesome quote, but it's so true that during these downturns in the market, most people, they lost a lot of money in 2008, but if they would have held on, their money would have come back.
Yeah.
Now, depending on their circumstance, it would have been difficult depending on how they were invested, but the money eventually came back and you'd have still really good returns. I mean, a lot of this data I'm sharing is taking into account 2007, 2008, 2000 to 2002.
Yeah.
And so it helps you behaviorally, helps you to do average things.
Everybody wants to feel like they're average, I'm sure.
Yeah.
Which is a tough thing to do, right? Again, we had it very recently over COVID, the COVID years of these meme coins or Bitcoins or stocks like Tesla, as you mentioned, or GameStop, or these like outlier things happening where you had these multi-millionaires happen overnight off of what I think is luck, right?
Yeah.
There's a lot of luck that plays into that. And so there's kind of that mindset of, look, if you want to risk things like that, be careful.
Yeah.
If you want to stay average and make sure that your investment grows in a more predictable way, that's another way to go. But I guess everybody has their own kind of mindset and their familiarity or comfort with risk as they're making these decisions. What is style drifting?
I kind of just explained it.
Okay.
So style drifting
is that something where you're actively moving things into these things?
No, that's just something that people tend to do without realizing it.
Okay.
So they are invested in growth companies.
Period.
Yeah. So they invest in growth companies, and growth companies, tech companies especially, coming out of COVID 2020, 2021, we're going bananas. So there were some individual companies that just went crazy, especially companies that when we were forced to be at home and not see anyone, those companies, DocuSign, where you can't see anyone, or Zoom, they all went crazy. And so what tends to happen during those periods of time is people style drift, meaning they start to concentrate themselves in these companies. And it's happening sometimes people not even realizing, because the share price or the value of that company has just gotten really large in their portfolio. Now, a prudent person, someone unemotional, would sell high, buy low. They're just constantly doing that and rebalancing. But it's hard to do that when you're watching a position go, double and triple and quadruple the share price. But if you look at the backside, so you come back to 2022, especially tech companies, I mean, the overall market was down, but if you go and look at a lot of these tech and growth-oriented companies, some of them came down 50, 60, 70%. And that might not sound like a lot. Well, I hope it sounds like a lot, but if you had $1 million and you lost 50% of it, a lot of people can't handle that. I mean, this is their life savings. This is money that they've worked hard for and saved at, and to have it come down so quickly. And so you have to learn how to you have to learn how to control your emotions. A lot of times the most successful investors are people that simply stay the course and have a plan in place, and they don't get too high when markets are up, and they don't get too low when markets are down. And diversification helps do that, where style drifting or concentrating into some of these positions, it might be great for a period of time, and you can brag to your friends and family that the outsized returns you got, but it's a marathon and not a race. So
is there a logical way to look at things like that? You talk about those companies that did so well in that time, and maybe their stock price was elevated and then it drops back down or normalizes. Is there something that we're looking at there of like, okay, are we looking at their revenue isn't really making sense with their stock price? I guess that's the general question, is what are some metrics that you can look at within a company to say, okay, their stock price looks a little bit elevated or low?
Yeah. I mean, that is the difference between growth stocks and value stocks. So a growth stock, it's a growth stock because it's based on the PE ratio, or the price to earnings ratio. And all that means is what's the share price and what are the earnings of that company. Growth stocks have higher PE ratios, meaning their share price is higher than what their earnings are showing.
Yeah.
But the reason it is because of expectation. So the expectation that Apple comes out with a newer, fancier phone, so people are willing to pay a higher share price for the future profits that will provide.
And is this something where you look at Twitter, which is now X, or something that for years never showed a profit but still had a rising share price?
Exactly. Yep. Okay. Same thing. So, and that's how where a value company, the price is more in line with the earnings of that company. But how I think of it, so that's not something that I'm doing per se. That's something, again, that the fund manager, so you go a level deeper, the fund managers are determining. So they're diving into the weeds and saying, okay, what stocks are we wanting to buy and why? And they're looking at that kind of data and information. Generally speaking, I think of it as in the short term, you're going to have movements because of price and earnings, but in the long term, if it's a successful company that continues to hit its marks and continues to sell products to people, then you're going to see the return of that company over time, which is how I would look at any of these companies that you're investing in. Some people don't invest that way. Some people, day traders, people that are investing for short windows of time, shorting stocks, using options, their timeline is way different than the majority of people that don't care what the share price is now or in a year from now. They're going to care about what the share price is 20, 30 years from now when they need to start pulling money from those investments. Could be shorter, could be longer, but
that's cool. Who should I be listening to?
That's a good question. I'm
talking specifically stock market now, right? Like stock market, who should I listen to?
I love the book, The Psychology of Money. Morgan Housel's the gentleman that wrote that book. He has a podcast. He's not technical. His is all behavioral. It's all principles, but it's really good. And I think the reason I like him so much is most of the time, most of the principles he's talking about or teaching, the stories he's telling are very applicable to most things in life, not just the stock market or not just investing. So I really like him. I listen to a few other podcasts that I like. One in particular, it's called Animal Spirits. Okay. Financial advisors, they're financial advisors just like me, firm out of New York, and they are really funny and entertaining, but they do a good job. They're very data driven, which I like personally.
Yeah.
So they have callers call in sometimes and ask questions. And they do a really good job of just breaking down kind of currently what's going on. So with all that said, the reason I like some of them is they break down currently, so I kind of am in the know of what's going on. But as far as listening to news or anything, I think it can actually hurt you more than help you when you're...
Maybe a better question is, who should I not listen to?
I got another something for you. So to your question on who should you not be listening to, you shouldn't listen to the news.
Okay.
Any news source. I'm unbiased on who I care that you don't listen to. So this one that would be great for you to throw up, it's showing the repeated news headlines. So, and I think the point that this is saying, so I'll read off some of these in August. So this is the bubble one, the stock market bubble. Yeah. So you often hear in news headlines that there's a bubble. So we're in a bubble, 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 bubble. They love that word. And it shows in August 9th, 2017 is the stock market a bubble, USA Today. June 2016, is the stock market in a bubble again, CNN Money. September 13th, 2015, fears grow over U.S. stock market bubble, Financial Times. May 6th, 2014, time to worry about stock market bubbles, New York Times. So, and I could keep going.
Yeah.
And they have some of these repeating headlines that show that with news, which it's important to remember this, that news, they're not trying to sell you or get you to pay attention by giving you just sound investment advice. Imagine if a news article said, stay the course, don't worry about your money for 20 years.
Everything's okay.
Everything's fine. Like no one would click on that.
Yeah.
And so they have to say things like this, that it's usually fear or greed. Like greed, you're missing out, you need to get in, or fear, you better pull out, you better sell. Why are we in a bubble? What's going on? Because it'll get you to click on it and read it. And so I don't like the news for financial information at any point or any time, because most of the time it doesn't help you. And that's not to say that I don't pay attention to what's going on, current events. I mean, there are certain things that can factor, broadly speaking, but in the short term, most of the time, it's just going to get you worked up and emotional and cause you to do something that you most likely shouldn't be doing as it pertains to your investment portfolio.
I have a personal bias against news, not the outlets in particular, but just in general with news. And there's a book called Trust Me, I'm Lying, which if you haven't read it, read it. The guy is a mass media manipulator, is what he coins himself as. And the quote that I got from there was, the most powerful predictor of virality, or how fast a news story spreads, is how much anger the article provokes. And so that's where, to your point, like news outlets, internet blogs, whatever it may be, they are paid based on how many people click on it, read it, share it, so that people can see the ads on their pages. And so, sound advice is not what they're going for.
Right.
It's how can we make people angry and do things. So I think those headlines, I'll throw those up here too.
Yeah.
Let's go back to money.
Yep.
10% return.
Yep.
Dallin guarantees me 10%. No, I'm just kidding.
I do not.
We'll have to disclose that out of there. What does 10% a year look like? Like from a compounding standpoint, what does that mean for people as growth happens, and why is compounding important?
Yeah. Compounding is amazing. It's a miracle. Here's another stat for you. So now this is a wild stat. But this is just to show the power of compounding. Okay, so don't feel bad. Most people feel bad when they hear this, but for a few reasons, which I'll explain. But 81.5 billion of Warren Buffett's 84.5 billion net worth came after his 65th birthday. So virtually all of it came after. Not that 4 billion or that difference was a small amount. But the reason that stat is wild, and that's pulled from that same book, The Psychology of Money, is he talks in it about the power of compounding interest, and he uses Warren Buffett as an example, because everyone thinks of Warren Buffett as this amazing investor, which he was. Yeah. It's not to take away from all the returns he did, but he also started investing when he was in his teens. Like if you go read biographies about him, since he was young, he wanted to be rich, and so he started to invest. And so he's had such a long life. I don't know how old he is now, in his late 80s, early 90s maybe. I know he's up there. And so what that stat... 93. So what that stat is showing is how much the success of his returns have come from just the fact that he's just been at it for so long. And I think that's a plug. When I hear that, whether you're 20, 30, 40, or 50, it's just a plug to get started and to stay the course. So you're not going to be, most people are not going to be Warren Buffett and be able to achieve the kinds of returns he got, but also start so young and have that money start to compound. But it's a snowball. I mean, if you think about it, if you go from $10 to $20 or $20 to $30, and then now moving forward, you have $30, and then you have $60, and then you have $120. So just slowly your money continues to compound and double. And the larger it gets, the easier it becomes to continue to accumulate that wealth. And so the other thing I love about the principle of compounding, though, is it's not that immaculate in the short term. Meaning in our day and age where it seems like everyone is rich and going on trips and vacationing and buying nice homes and cars, it makes people want to find those investments or find that stock that's going to get them rich right away. And for most people, that's just not how life works in general. If you're wanting to improve at something, you can't just go become an amazing basketball player like Erik if you don't go practice. Okay, you have to go do shooting drills and practice constantly. And then over time, you get better. And I think the same thing applies to the market, and I think it's healthier for people to say, okay, you're not going to see the benefits of compounding over the next 1, 3, 5, even 10 years, but before you know it, you're going to be retiring and be like, wow, I was saving $1,000 a month, and that's now well over $1 million without me even realizing, because in those last 5 to 7 years, you had just been slowly accumulating, and then you really start to see the benefits of that compounding. And you see it lasting into retirement where you don't have to put money in anymore. Yeah. And that money continues to accumulate even when you're pulling from it. So it's amazing, but it's also just healthy, I think, for people. I'm here sounding like my dad or my grandpa again saying, work hard, And but I think there's a good underlying principle behind it. So
well, and the vast majority of our subscribers and viewers here, at least, are approaching retirement at this point. And so we hear the power of compounding. And if you would have just started in your teens like Warren Buffett, then this is where the numbers could be. And I even feel that now, kind of coming into my age and looking back, in my early 30s or 20s or teens, if I would have started, but I've missed all that time.
Yeah.
So what do those who have already missed that time do?
Yeah.
What are their options?
Yeah, it's a great question. Usually I remind them that they still have a lot of life to live. So people retire at 60 or 65 or 70 or wherever they fall. They can I mean, they could still have another 30 years of life in front of them. And that's a long time horizon. And most people, everyone thinks like, oh, I retire, my money just sits in a bank account and I spend my last dollar on my deathbed. And that's the perfect plan. But it's not usually. Usually a good plan is someone whose assets are staying level or accumulating over time, meaning that for many, there's a large portion of their assets that they will likely never tap into or touch. And that's not because they're hoarding it or they're not wanting to enjoy life right now. It just lends itself to a more comfortable retirement because it's a real hard psychological shift going from being a planter for your whole life to all of a sudden becoming a harvester, where you're now starting to harvest the fruits of all that work over that period of time. And it's hard for people. I see them, and it's really hard. Even in our software and our analysis, we can model people, and even if their account's coming down, we'll say, well, yeah, it's coming down because you're pulling more, you're tapping into the principal, you're living a little more than you should have accumulated a little more, but still you're not going to run out of money till you're 115.
Yeah.
Even for those people, they just tend to not enjoy their retirement as much, or they feel like they need to go work again because they're just watching their account slowly come down, versus someone who's staying steady or increasing. They enjoy it more and they're more comfortable. They spend more of their money with their kids and grandkids, which I think is important to balance the two of not just accumulating everything to leave behind to your posterity, but enjoying some of that with them while you're here with them. And so all that to say that compounding still can benefit you immensely, whether that's compounding in the market or any type of investment that you're investing in, that principle still holds true.
Yeah.
So
very cool. Yeah, I have that internal dialogue with myself a lot, and I know we've talked about it as well. There's the story in the book of the guy who was a janitor his whole life, and then he passes away, and it turns out he's got, I can't remember the number, I think it was like $6 million.
Yeah.
$6 million, and so he gives $4 million to the library, and then $2 million go to his kids or something like that. And they're just talking about how he scrimped and he saved, and he just lived so frugally his entire life when he could have been enjoying some of it, right? Like that's millions and millions of dollars that... So there's a part of me internally that wants to find a balance there.
Yeah.
Okay, we got to make sure that we're putting this in, let compounding interest help us and put us in a spot where when we retire, we aren't going to lose everything or spend ourselves out of it. But at the same time, I do want to live a little bit while I'm here.
And it's a delicate balance. I'd like to think that we help individuals find that balance where we're not just telling people you need to save more. You need to, you need to eat ramen noodle for the next month because you need to save. In a lot of our conversations, we're telling people you should spend. You need to spend more because you're not taking this with you. My dad calls it the ski program, spend kids inheritance. He always loves to talk about that and makes it really clear to me that that's what he's doing for all of us siblings. And so, but I think there's truth to it. As much as he jokes, I think it's good. Like when I'm older, if I've accumulated and been fortunate to do that, I would much rather take my kids and grandkids on a trip or go do a humanitarian trip and see the benefit of some of those dollars versus passing it to them after I've passed, which can bring a whole host of other issues that we won't get into today. We've seen some horror stories of that, and so anyway.
I think we can kind of start wrapping up here a little bit with what do rich people know that you don't?
Yeah.
I guess not you personally, but what do rich people know?
I don't. One of the things I put was, which we were just talking about, is that discipline or delayed gratification. One of the common themes that I've seen with a lot of the clients that I have the opportunity to work with, and I'm fortunate too, is they learned how to delay some gratification, not all. Yeah. So, but there's a common thread of them understanding to always put some away, or anytime they got a pay raise, the first thing they thought of was, where can I increase my savings? And then where can I enjoy the rest of it? So it's not you get a pay raise, it's all going to make sure you're maxing out your 401k. or to go and buy another investment property or to go towards your HSA account or whatever it might be. It is them doing a portion of that, but then also saying, and then we're going to enjoy some of this too now.
Yeah.
And finding that delicate balance. But they all at least did that, because most people, not most, well, yeah, a lot, most, they don't do that. They get a pay raise and their standard of living jumps right up to where it is without anything in between, not thinking about the future. And so going back to the compounding and the power of that in any kind of investment, as long as you're consistently doing it and sticking with it, very high likelihood that you'll be able to retire and enjoy that time when the time comes without having to, kill yourself to get there. It's just that principle. And so I think that's one that it's not, a lot of these people, it's not like they were making crazy money. Like the janitor in that story, I think that was the point that he was saying is this guy didn't make a ton of money, but he ended up with $6 million. Anyone can, if you stick to a plan and can stay with it, can accumulate enough to live a very comfortable retirement, regardless of what that number is and what you're comfortable living off of. And so the rich people in their minds out there, a lot of times it was just brick by brick, slowly, which I've observed and seen. One other, the other note I put, it's not a marathon, or it is a marathon, not a race. I kind of touched on that a little bit. The brokerage account. So you had some questions about that is. The reason I listed a brokerage account in this context is because most retirement accounts, you're maxed out on what you can put into these.
There's a limit on how much a year you can.
So whether it's a 401k or an IRA or a Roth IRA or an HSA, there's limits on what you can put in those. And so a lot of wealthier people, they'll then turn to other avenues like a brokerage account. So a brokerage account's just like a savings account, but it's an account that you're investing in stocks and bonds instead of just sitting at the bank in cash, but it's liquid. You can get to it at any time, but oftentimes these accounts become really large because there's no limit to how much you can be saving in these brokerage accounts, and then they start to utilize those. One or two really common ones, maybe two. There's others, but for the sake of time, two of the biggest that we see is they will become their own bank with that brokerage account. So you can set up an S block or a margin account or S block, but it's just like a line of credit, like a home equity line of credit on the equity in your home. And it's a line of credit set up against that investment account. And so you can so if you wanted to go buy a car, and right now rates are high, not as enticing. When rates are lower, previously when they were lower, if they ever go back down to reasonable rates, then people will say, oh, I want to leave my money invested and continuing to grow, hopefully achieving the 10%, 8 to 10.
Yeah, it's coming down.
You never know.
Yes.
Then I'll leave my money invested there, and I'm going to borrow money from myself essentially to go buy the car, and then I'll pay it off with my cash flow. They do that with real estate too. So some people that like to buy real estate, they'll build up this brokerage account, and then for down payments on these real estate properties, they'll borrow from themselves, put money down on a real estate property that starts to provide cash flow, and then with that cash flow, they use that to obviously pay off the debt on that property and pay off the money they borrowed, allowing their investments just to continue to grow. So that's one. The other one is for those that are charitably inclined. So especially in Utah, people like to give, which I think is great. To any 501c3, if you wanted to, appreciated stocks are great assets to give to whether it's a church or a charity or a nonprofit. And so you can go, just to explain that.
Yeah.
So you buy Apple for $100 and it grows to $200. That $100 gain, you're going to have to pay taxes on if you sell that position. But what you could do is you could say, and let's say you had $100 that you were going to give to a nonprofit. You could either give them that $100, or you could say, I'm going to go buy Apple. I'm going to take this $100 and then I'm going to transfer this stock directly to them. And it avoids you paying that gain because it's a 501c3.
Yeah.
And so a lot, especially when you have wealth and your situation looks good, hopefully you have an inclination to give back. And so it becomes a great asset for you to give in a really tax efficient way.
Yeah.
So
That's cool.
yeah.
I kind of want to wrap up with this question here.
Yeah.
Well, and we'll see where it goes. But why use an advisor instead of just buying, to your point, an index fund?
Yeah. It's a really good question. I think for some people they don't need to. I think for some they should. I would probably sum it up. The simplest way is, for me personally, we protect our clients from themselves. That's a big benefit that's hard to quantify. But we do. 2020 was a great example. So I had a few clients in 2020. So this was COVID. And I don't know if you were paying attention in the stock market that year, it was a roller coaster.
Yeah.
So, and it was scary for a period of time. So it was the worst. I wasn't in the business in 2008 when we had the major recession. So we've had some dips, but 2020 was the biggest downfall that I'd seen while being in the business. And the market dropped almost 35% over a month or so, roughly.
Yeah.
And there was and when it's dropping, you don't know when it's going to turn around. The pandemic was new, so people didn't know how to respond to that. Demand was shut down.
Everyone's losing their minds.
And rightfully so. I don't blame people for feeling this way, but we were getting calls and saying, "Hey, we need to get out. We need to sell." And in some cases, I'm a younger guy. These are people much older than me that I think are much wiser than me. The only benefit, again, that I have is that I do this every day. I'm looking at markets daily. I'm studying. I'm bettering myself to help my clients. And so I, again, was going back to the mounds of data and saying, hey, you don't want to. And in most cases, for the individuals that reached out, we had a plan in place. So we knew that they didn't need to get to the money. And if they did, there were components or segments of their portfolio, more conservative investments that we could tap into if they did need some cash. And I just talked them off the ledge, essentially. And because of that, now I didn't know at the time where the market was going to go, but if you tracked it, or if you go and look, you Google it right now and just go look at what the market did. In 2020, it ended up being positive double digits that year.
Yeah.
So from down to all the way up to where if you would have gone into a coma at the beginning of 2020 and woken up at the end, you would have been like, oh, it was a great year in the markets without realizing what you went through.
Nothing bad happened.
To get there, yeah. And so that's what I mean by we protect clients from themselves. And it's not that simple. I think a lot of that also comes from a plan that we put in place. I refer to a plan often. It's just cash flow, balance sheet. We're looking at tax implications, estate planning. So there's a lot there. What we do is not rocket science. We just do it, and other people are really good at other things they do. Business owners, professionals, they spend a lot of time doing those things, and they like to delegate. And so there are do-it-yourselfers out there that I think can do a really good job. Like I think someone could go, and if they're disciplined, they could go put money in an index fund. They might not be as proactive about tax loss harvesting or gifting or some of these small little details, but they can still accumulate and have a really successful financial plan where a lot, it's just time, and time is money. And so it's easy for someone to just simply know, oh, I just call Dallin if I have a question, as opposed to going and, Googling, figuring it out. Some people love it, some don't. And so I think it's just finding if there's a good fit. Yeah. Usually younger individuals, especially when they reach out to me, I will give them advice, but tell them you don't need to work with someone like me right now. There's a lot of good solutions. Whether it's an index fund or there's robo-advisors, if you've ever heard of a robo-advisor, that essentially you input your data, information about you, and then it spits off a portfolio and it adjusts. So it's kind of just robo advisor, talking to a robot about investing your money. And obviously that's going to be less expensive than working with an advisor like me. But I think humans, I've gotten the question, are you worried that you'll be replaced by a robo advisor, AI, at some point? And I think a lot of what we do regarding money, which is why, again, I love the book, The Psychology of Money, is behavioral. We're humans, and it's hard to take emotions out of the what should be rational decisions. And we vicariously do it through hundreds of different people. So I've said this for the 10th time now. I'm not that smart. I vicariously live through a lot of other people and see what works and what doesn't. And then I can provide that insight to anyone I talk to and say, oh, I saw that. I saw someone do that without telling them their name.
Yes. Yes.
And, but I saw someone do that. It worked or it didn't work. And so I think it's just that it's having a friend that trusts you. Obviously there's a spectrum of advisors in our profession, some that do a really great job and some that not so much. And so it's just finding that balance and deciding for yourself. I don't think it ever hurts to go talk to an advisor and fill it out. And hopefully you get someone or talk to someone that is pretty open and transparent and you understand how they get paid and all of that. So
if somebody watching this is like, I think that Dallin is lying and that he's actually a lot smarter than he's leading on here and he's a sharp guy and he knows what he's talking about, where should they interact with you? So I have a website. It's on my we'll throw it on here too.
Yeah, it's on my company site, so it'd be great if you put a link there, but it's a personal page that I created because I do some content too. Nothing as great as yours, but I do content for my clients, and so the website that we can link to has videos, and you could subscribe to my newsletter, and any new videos that come out, you'll get notified and get to watch my, silly little videos I do with all my silly little jokes. So.
I think your videos are fantastic. This is the last question. It's the most dangerous question. Who is your ideal client? And I know you're going to say, I'll help everybody, but what does your ideal client look like?
Yeah. I really will help anyone. Meaning I might not work with you, but I am always open to talk to anyone who wants to learn. And hopefully I've shown that with people that have reached out. It's the reason I make content. That's why I got started doing it in the first place, because there are a lot of people we can't. Because of the time we spend with the clients that we engage with, we have a $500,000 limit of investable assets, so they need that much for us to manage for them because that's how we get paid.
Yeah.
But with that comes all the planning, the estate and tax and retirement planning that we provide for that client and spend a number of times. So it's not because I always feel like a snob when I say, oh, you need to have this much money to work with me. But it's business. It's so that we can, some advisors work with thousands of people, but if you do the math on, okay, they're working with 1,000 people, how much time do they have in a year to talk to me and to really dedicate time? And so you do have to limit that, and you do by increasing the minimum that you're working with. But so as far as ideal client, obviously if you're above that, then me or someone at our firm would love to talk to you. And that's really it. Some of my really wealthy clients and some of my less wealthy, it's more personality than anything, in any industry. And so that 500,000 threshold, I think.
Very cool. Well, thank you for we've been going at this for an hour and a half at this point. So thanks for taking the time and sharing your wisdom. I hope to have you back. Yeah. And learn more about financial stuff, because that's not my world. We're the Medicare nerds.
Yeah. Well, awesome. Thank you for the opportunity.
Yeah, man.
So hopefully it was helpful.
Yeah.